Well, I think the market is looking for an additional bit of stimulus, an additional catalyst to push share prices higher. I think they believe that the Congress will come to some sort of an agreement. Certainly the president, because of his looking to cut funding for the post office, sort of has triggered Congress to come back and to come to some sort of resolution. So it will likely happen, if not this week, then certainly next week. I think that possibly Warren Buffett was looking to hedge his bets because we are seeing a very low interest rate environment that could get even lower. We're looking at a softening of the US dollar, an increase in the deficit, as well as the concern over the coronavirus. So that's caused the price of gold to be going up. So I think that with that kind of an upward trajectory, he was taking advantage of price action and also hedging his bets in case things don't go as planned. Also, he's seen to be lightening up on the financial stocks, banks in particular, but that's a group that really could take a while before it turns around. It's among the few that posted even weaker than expected results in the second quarter. Only energy was the other one to do that. And for all of 2021, the financial sector is also among the four that has actually seen a reduction in earnings estimates as compared with the other seven sectors in the S&P that have seen increases to their 2001 forecasts. Well, in such a low interest rate environment, I still think that growth is the better way to be leaning. I think investors might be moving away from growth only because they're worried about how strong the technology stocks have been. But every time that these investors then gravitate toward value, they end up getting burned. I guess you can say the take on the old saying is, fool me once, shame on you. Fool me 20 times, shame on me. We at CFRA have a buy recommendation on JP Morgan. So these are some stocks that are traditional, consistent gainers in terms of earnings and in terms of dividend growth. So if you happen to be a long-term income-oriented investor, then I would say you could probably be picking up some of the financial stocks at pretty attractive values as well as dividend yields right now. And if you can sit on these stocks for a while, you can look upon them as an alternative source of income, similar to bonds, if you will, that have a good upside potential when the value stocks start to come back into fashion. Well, I think the reason that companies do end up splitting their shares is to make it more appealing to a wider audience. It used to be that the stock price was best positioned if it was between $20 and $80. And then once you got meaningfully above the $80 per share level, companies considered splitting their shares. Since the tech stocks have really taken off, and also because Berkshire Hathaway was the one to first come out with the thought of not splitting shares, then companies have just let their share prices ride. But now we see Apple cutting shares, we see Tesla cutting shares, and I think the reason is they're simply trying to broaden the appeal to retail investors. We are favorable on Apple, but not as favorable on Tesla. So it really just depends on what the investment outlook happens to be for that stock. It's not a great buy when you can buy a stock that is not a good investment at a lower price. Does not make it more attractive. It makes it more reachable by the average investor, but it does not imply that it therefore has become a good investment. Certainly the market now being up more than 50% since its low 5 months ago. That is a lot stronger than is normally the case 6 months after a bear market bottom. Usually the market is up by about 30% going back to 1929. So I believe that the stock market is likely to go through some sort of a digestion of these gains. What I have found going back to World War II is that whenever the market established a new all-time high, that it then collapsed from exhaustion shortly thereafter, giving back an average of 8%, but as much as 14%. So there is a likelihood that we could be seeing this market offer a much more attractive entry point, which investors, I think, should take advantage of.